like you're moving into a cool like bitchin' house, you're super stoked about it, and you buy a jacuzzi for the new house. Or you're buying like something like, hey, I need to buy couches for the new house,
Yeah.
so I should put them on my credit card because I'm closing, right? And then they think,
Yeah.
and then it's like, heck
I
no,
always
dude,
say
you just
we're
spent
not
seven
we're
thousand
not done
dollars.
yet. We're not done yet until that money crosses the line and it
Yeah,
goes into escrow. Just act like
you
you
got to
just
sit on beanbag chairs until you get your
yeah
when you
yeah.
first move in there. Worry,
You know,
worry
I
about that
mean,
when you get in there.
re-
Welcome back to the Peak Show. I'm here again with Harry Bennett. It's been about 9 months, probably. Harry, how you doing?
yeah, it's been some time, but definitely love to see your show that's going on here, and keeping everybody informed. I really appreciate that. So
Yeah,
thanks for having me on.
it's definitely made some transitions. The YouTube channel has made some transitions from being strictly real estate focused to real estate and other business, and introducing
Yeah.
people to people that I know, like, and trust, other industries, maybe other resources, other ways of thinking about things. But still, the foundation is still real estate, painting, and any local business topics, which is super interesting to me. So I know you
It's
as
it's
well.
it's funny that you're in the painting business and in the real estate business, because isn't it like painting is like the biggest return on investment as far as the value, right?
I think probably in terms of like if you're selling your house, you're going to have the quickest visible return on investment in terms of somebody walking up and being bang, the house looks awesome. That's my first impression, is the house looks awesome. In
Right.
terms of overall, you could argue remodeling or adding a room onto your house or remodeling the kitchen is probably more important, but something like that is like $60,000-$70,000, right?
Yeah.
Painting a house is like 8 to 15 on an average house. But
Hmm.
yeah, they go hand in hand. But I wanted to bring you on here to catch up about the mortgage industry. Not so much. I don't really want to go into too far details of like what the rates are and all that stuff. We want
Yeah.
to talk more about some sort of things that have come down the pike, or things that are kind of possibly changing this summer. And I wanted to also speak on DSCR loans, and maybe some interesting properties and house hacks that you can get into as a real estate investor that way. So, how does that sound?
Yeah, sounds like a good plan to me. I know that the interest rates, everyone's kind of waiting for that tidal wave to break, right? They're waiting
Yeah.
for like that big break where they announce their first cut, and then that's going to be the trajectory of like, okay, now we're going the other way now.
But didn't the Fed say that they're don't expect one until the fall? Like they're not
Yeah,
going to make any major cuts.
right. Yeah. So they still they're still like there's some Fed members that are still saying, hey, let's even hike it again, right? There's
Right.
not many of them saying that, but still it's just the thought I think out there is still it's for the most industry experts have been talking about this subject for the last 6 to 9 months. We've all
Yeah.
been saying, hey, in the next 6 to 9 months, you're going to see rates better, and it just hasn't really gotten better, to be honest. So it's still tough to get approved out there where the rates are at, because of it affects your ability to afford that home. However, we're seeing more investors. Me personally, I'm seeing more investors, first time investors, because you have people that have tons of equity,
Hmm.
and what is the equity actually doing for you at this point in time? So we're seeing a lot of people tapping into like second mortgages, HELOCs, and then they're using that equity, that money, to then purchase other assets, or they're consolidating debt. So that's kind of what we've been seeing lately.
Yeah. Well, or upgrading. I mean, if you can afford the uh, if you can afford the interest, you have enough equity in your current home, and you want to upgrade, then a hefty down payment's not going to be as much of a blow for with
Yeah,
a 6.5%, 7% interest rate.
right.
That's what
Yeah,
kind of like
absolutely. Yeah,
kind
if
of
you have
like
enough, I mean, or we've seen the accidental market, right? Where accidental landlord market, where maybe they have a really good payment on their first mortgage, and they have tons of equity, and they want to move up.
mhm.
They just retain that property, and if they already have some extra reserves, maybe they're doing pretty well, and they can go ahead and just put 5% down on their next home, rent that property out, get that off their debt to income ratio, so that way they can qualify for another nicer home. We're seeing that too. So still seeing the generational wealth kick around, and people grabbing onto that wealth and compounding with it.
I wanted to go over a hypothetical kind of scenario, is something that we might have to deal with in the near future. You never know. But I've heard in some markets that some sellers are not paying a buyer's commission. I've heard it from other realtors in other markets in my in my Tom Ferry sphere, saying that they've come across listings that say no buyer commissions, and so that you're going to have a buyer agreement with a buyer's commission, kind of outlining your agreement with your buyer. From a mortgage lending perspective, the first thing I think about is, well, then my clients have to, let's just say $800,000 house, 2%, $16,000 commission, right?
Yeah.
They're going to have to qualify for, that's a 2%, 2.5 is 20,000. Let's just say 20,000 for a round number. The buyer's going to have to either be able to qualify for $20,000 more, right? Or they haven't come up with, it's so new, they haven't come up with like other programs or other ways to buy down that or pay that commission out of something else.
So the bank's only going to they're only going to lend to either the appraised value or the purchase contract agreement, whichever's less. Mm-hmm. So there's not really an area where it's like, hey, we're going to go ahead and tack on the realtor's commission. They haven't rolled out something like that to my knowledge yet, where it's like, hey, we're going to go ahead and, because then all of a sudden your loan to values are getting pushed up.
Right.
Maybe it's not putting the buyer in the best position to do something like that, where originally they were putting 5% down. Now it's more like it's 3% equity in there. Mm-hmm. So they haven't come out with anything like that. But what I would imagine is that I feel that you may have sellers that have that kind of a deal, but you're going to have buyer's agents that are savvy, mm-hmm. that will be like, well, maybe we'll go ahead and we're going to offer this price, and that's going to cover the comp, right? That's going to cover the buyer's commission, maybe, mm-hmm. Maybe as long as it appraises that way, right. So the value's still there. But the other option would be maybe you can get some type of a lender credit to help you out with that, but or other contributions from family. But there's nothing that we can just bundle it all and say, hey, all the closing costs. I mean, you can do it on a refi, right? I mean, not obviously you wouldn't have a realtor commission, but in a refinance, you can bundle in all your closing costs. So you just can't do that on a purchase.
Yeah, and there's been a lot of different people that have approached it in different ways, because there are people now that I've spoken to that, let's say the scenario is the seller is going to offer, it's 5%, 2.5 per side, but the buyer's agent, let's just say they're used to getting 3%, and so they always have in their buyer agreements like it's 3%, so the buyer pays the 0.5% difference. But they would have to qualify for 0.5% more as well. So there's already been people that have done this, but I think when that happens, it's usually like a buyer that can just afford to pay the percentage. But I'm thinking more of like first time home buyers that are possibly going to be stuck with the burden of paying their buyer's agent. And that's when you see like these online companies like Redfin or companies that can do like very low, like 1%, or they very low, but it's a lot less management, a lot less personalized service. I know that Redfin, I think, has like a program where it's a couple percent or something, 3%, and it's like 2 to the seller, 1 to the buyer, or something like that. It's like
right.
It's a weird split. But I'm just kind of curious how that's gonna go down. If that happens.
I would imagine the good savvy's buyer agent, right? They're going to look at the house when they get an escrow, and they're going to pick that sucker apart, so.
Yeah, and I think the seller's agents are going to understand that that's just how it's going to be from now on, where it's just like the offers are not going to be like at price or over asking. It's going to be like within that margin of 2%,
Yeah.
There's another thing that I heard, I was reading too, like possibly you won't be able to disclose like the commission on the MLS.
Right. Yeah. Because that way, something about that is going to deter the buyer's agent to be like, okay, this guy's not even paying a commission, so I'm going to.
Right. So that way, yeah. So even if the seller's like, yeah, let's just pay the commission, that's just the way, it goes, that you'd have to like I don't know if it would be like, if it would be even illegal to text the buyer's agent like, hey, just to let you know, it's 2.5%. So show the house, please. Like, so since you can't like put it on the MLS, and I think this topic has been like talked to death, like in the real estate world. And I mean, I have a lot of non-real estate people, like clients and friends, ask me about it, and they don't even know like what the case is called, but they just know that like, hey, how are you going to make money in the future, like from now on? And I'm like, well, I'm not worried about that. I think that there'll be a way, or else, there's always a way. There's always like, everything changes. Everything changes. And maybe it'll be for the better. Who knows? But
I think what it really comes down to is yeah, you're going to have probably some sellers out there that's like, hey, I'm not going to offer anything.
mm-hmm.
Right. And then you're going to have majority of people saying, well, look, I need to move. I need to sell the house quickly. I want to have a smooth transaction. I don't want any fraudulent crap going on.
Yeah.
I don't want any weirdos come, like I just want to, I'm okay paying the commission. I want to make sure we're closing and move it along,
Yeah.
I think that's the majority of people. I think really what it is just making sure that like the buyers and sellers are getting that disclosure now, right? That's where they didn't really have that before, I guess, or some people felt deceived.
We might see some more like an uptick in like buyers try to buy houses without representation. Like how you have FSBOs? You have FSBOs, like you have like BBBOs, like, or wait, buyers, bought by buyers only, or I don't know, something like that. But where you might have somebody who gets like a lawyer or like we help you legal, like paralegal person to look over the documents and just say, hey, what should I write, when and where, and just, pay someone to help them prepare the contract, but basically just go at it and negotiate it on their own.
Yeah, I mean, I'm sure there's going to be like tiers of service, right? Like, hey, like maybe you might even offer a tier of service that says, review of contract.
Yeah.
$5,200, whatever. Yeah. I don't know.
Well, we have like a house placement service, which I think is like half a month's rent. So Karen will vet them, do background checks, run applications, run credit scores, and get someone in your rental and charge you half a month's rent, but she won't manage it month to month. But she'll do that. And so like it's almost like the same thing if you have like a buyer's contract review and be like, just send me the thing, that just seems like a lot of work.
You'll be a contract specialist.
But you also don't know the ins and outs of the house. You didn't go there. You don't like know, you're not going to give them advice on like what to negotiate. You're just like, did you fill it out correctly? Yeah, you look good. All right, cool. Good to go.
Yeah. Yeah.
But you want some advice. Oh, guess what? That's going to be this much extra. Why don't you just pay me a commission and I'll just do it for you? Like, and show you houses.
Price. Yeah.
Because there's not like in your world, there's not like I can do this much for you. I can do a little bit for you. I mean, it's like you're just getting them a loan, or you're not getting them a loan, right?
Right. Yep, that's very true. I mean, it's either you're doing it or not. I mean, we don't get paid until that loan funds. So if someone switches lenders at the last hour, that's tough crap. Really, it's you've lost the commission on that home. So when you get into a contract with somebody, it doesn't necessarily mean that you guys are married at that point.
Right. And things can go wrong. I mean, we just closed escrow on our personal home, and it took a long time. It took like almost 7 weeks, I think, because we kept running into issues, and then we were so far into it that we kept giving them grace, and we're just like, okay, we'll give you another 4 days to figure this out. They had to run a bunch of stuff, and there were some issues having to do with, let's just say, things that you would tell your clients, don't do this ever while you're in escrow on a house, happened. And so people, it kind of just threw it up in the air. We're like, well, let's see what happens now. But we took the buyer's agent and the loan officer. We were just, we took their word for it that they were working on the solution, and they just needed more time, and it kept kind of going in that direction. And so finally we just said, if we were going to have to relist it, we're gonna have to restage the house because it's big, it's empty now, and it used to look really nice when we listed it. But everything ended up in the end working
Working
out
out.
just fine. But if you're the lender, I'm sure this has happened, where you go through this whole rigmarole, this whole process, and you're like almost at the finish line. It's like, oh, Harry, no longer a client, or
Yeah.
they're not getting this
Yeah.
house, and you're like,
Or
that's a
they
lot of
buy
work.
stuff or something like that.
Yeah,
Yeah. And
they buy a car, go out to
yeah, and if
go to
whoever's
Disneyland for the
listening to
weekend.
this, whoever's listening to this, just to let you know, every single lender, it's not subject to one type of lender. It's every lender out there.
Yeah.
10 days before they close that loan, they're going to do a soft pull on your credit, and they're going to make sure you didn't obtain any new kinds of credit. So if something has changed, then your loan approval can change, and that sucks. No one wants that.
Yeah.
So
Yeah, and okay, how about this? What if you get a pre-approval letter and you get your regular credit ran and you're like house hunting, and house hunting takes like 60 days to 90 days.
mm-hmm.
Is there any time during that period where like, hey, I'm going to go spend $5,000 on a jacuzzi, or just, you know what I mean? Like just buying like a big purchase, like what's the dollar amount threshold for an item, like a tangible depreciable asset or possession?
So my advice is that if it comes to, and you're my client, right?
Yeah.
You're my client, and you're pre-approved at that point. I'm telling you, if anybody's asking for your social security number, call me first. Like don't give out your social security number to anybody while we're at that stage, because the moment you go buy a car or that jacuzzi,
Yeah.
right, that extra payment is going to be added into your debt to income ratio if you've asked for a line of credit on that item.
Right.
And that's going to change your debt to income. If we're at like a high debt to income ratio already, if we're at like 44%, or maybe 49%, and you buy that jacuzzi and now we go over 50% or whatever, and that could change the whole deal. So jacuzzis, that would be a weird one to buy before buying, getting into contract.
Well, no, I'm saying okay, jacuzzi's a weird one, right? What I mean was like you're moving into a cool like bitchin' house, and you're super stoked about it, and you buy a jacuzzi for the new house, or you're buying like something like, hey, I need to buy couches for the new house, so I should put them on my credit card because I'm closing, right? And then they think, and then it's like, heck no, dude, you just spent $7,000.
We're not done yet. Until that money crosses the line and it goes into escrow, just act like
you got to sit on beanbag chairs until you get when you first move in there. Worry about that when you get in there.
Return that stuff. Figure it out. Yeah, that's a tough one. Yeah, so 10 days before they close, they're going to pull it.
Yeah, that's a tough one for sure, because everybody needs to spend money, but they don't know like how much they can spend. They think like, well, I need to buy my kid's tuition for mission prep, and it costs $5,000 a quarter or whatever, however much it costs. Is that a big? But that's a normal expenditure you can see on their spending record. It's not like a random purchase. That's what they're looking for, is like random purchases, or
they're looking for new lines of credit, or a certain threshold on their. Everyone's gonna be a little different,
right?
But if they have, let's just say they have like a $50,000 line of credit.
Yeah.
And when I pulled it, they only had $5,000 used out of there, and now they pulled it and they have $40,000 used out of there. That's a big difference in payment. That will be reconsidered. So
cool.
You want to be very diligent in that. Be very careful.
Duly noted. I knew that, but it seems like I wanted to bring it up because it's happened recently, and I know that it's happened to you.
Well, I think people, they think that they get in their head, they get approval, they get approved, and then they're off.
Yeah.
Yeah, they're off.
Yeah. It's like, yes, Steven, you can marry my daughter. And then like 2 months later, he's out gambling and like carousing all over Vegas. And he's like, but you can't marry her anymore. I gave you my approval, but now I'm pulling it back.
Yeah. Pulling it back. Man.
You screwed up.
You're a wild horse. Yeah, absolutely.
So I wanted to kind of switch subjects here to the DSCR loan. It's a very interesting loan. I think that I've got some questions about it. I kind of want to hear just your liner notes about it, and then I got some lead-in questions after that.
Okay, yeah. So DSCR, I guess we'll start with, what does it stand for? It stands for Debt Service Coverage Ratio, and basically, I personally, just how I view them is I view them as cash flow loans,
Yeah.
right? So as long as that property is going to cash flow above and beyond the principal and interest, the taxes, the insurance, if there's an HOA, whatever the property charges are, as
Yeah.
long as you're cash flowing above the property charges, um, that's the debt service coverage ratio. They want to make sure either most programs they want you to be at a 1-to-1. So let's just say your property charges are $2,000 a month. They want to make sure you're getting at least $2,000 in rent coming in from that property,
Right.
if not more. The more, the better, right? If you can show that you're making $3,000 or $4,000 a month from that property, and your payment is at $2,000, then that's a safe bet for them. That's how consider the cash flow, the DSCR is like your DTI on that property. So it's actually not even including the borrower. I don't need to look at your income. I don't need to look at your tax returns. You, in most cases, you only need to have reserves for the property itself. So this is great for investors, true investors that maybe have 2, 3, 4, 5 properties already. The documentation's a lot less than it would be on a standard Fannie Mae, Freddie Mac loan. So you won't have to have reserve requirements on every single property, because typically on conventional loans, they're going to say, hey, you need 2 to 3 months of reserves on every property, right? And your debt to income ratio is considered, right? So they're going to take a deep dive on your tax returns, see how you're filing your rental schedules, right? If they're having a losses or all that's going to get compiled in, and your income is going to be looked at as well. Where the DSCR, you don't have that. So what it is, great for investors, good cash flow loans for investment properties only, no second homes. What it's not is not for any second homes, no primary residences. It's
What about
not.
a duplex you're living in half of it?
No, it's
Oh
strictly
man.
investment. Strictly investment, yeah. So DSCR strictly investment only.
I knew the answer to that,
So
but I just
you can buy a duplex.
yeah.
You just can't live in it at all, or your family can't even live in it, right? They're very strict about it being a business purpose loan. And your whole scenario of your car payments and everything is not really looked at. They just want to know that you have a good credit score.
And that the
Typically,
property is going to cash flow.
640 and up, I want to say, is the lowest they'll go. But when you have a lower score, the higher the down payments are. So it's not a low down payment product. It's a high down payment product. Typically, we're seeing between minimum 20% down. But honestly, to make the deal work, you're probably going to be closer to 40% down to make it work.
40% down.
Yeah, around here. If
So
you're
a duplex around here is like 9 to a mil, like Osos.
okay,
9 to a million, like in Los Osos. In
Sure.
Templeton, maybe a million, maybe like 950. I'm thinking about the one that I own, the area. So yeah, I mean,
well, if you're looking at the actual cash flow, right? At the end of the day, a lot of investors, they look at cash flow, or they're looking at the appreciation of the property,
right.
And so there's different tiers to a DSCR. There's you could buy the property, and maybe you're looking at it from not a long term. Maybe you want to do a short term rental, right? So
Yeah.
you're going to you might be below the 1-to-1 DSCR, which you can do. There's investors out there that will go as low as a 0.75. So you're going to show a loss, right, on income coming in versus your payment. So you can have a little bit of a loss. Now, for like a accredited investor who has 12 months experience managing property in the last 3 years, that's considered a seasoned real estate investor. That person can even be eligible to do a no ratio program. Maybe they want to buy that big property. They already have the vision in their head what they want to do with the property. As long as it meets the appraisal guidelines, it's not like a fixer. These are not
Right.
for fixers, right? But it's got to be like, maybe you have a different vision for the property. And so your experience with real estate allows you to purchase that property with a no ratio loan. Your interest rate will be higher because of the accounting for that risk there. However, a lot of investors today, they know what they want to do. Maybe they're going to put another unit on the property. Maybe they're going to turn into some type of short-term rental. They have a lot of different ideas of how to make a quick buck out of it. So they can certainly do that with this program.
DSCR loans, percentage wise, what is it? How do they compare to like a single family residence like mortgage loan?
What do you mean by percentage wise? Oh, like how many
rate,
words?
like the rate of the loan?
Oh, the interest rate of the loan?
Yeah.
Okay, so like today as of May, you're probably going to be, if you're doing like 30% down DSCR, you're maybe looking in the mid eights, right?
Okay, it's like
Mid to low eights. Okay.
so better than a commercial loan.
Yeah, kind of similar to the commercial side, right? Now, if you're doing like an investment loan from Fannie and Freddie today, you're probably going to be in the high sevens,
Right.
realistically, mid sevens, mid to high sevens, right? Depending
Right.
on what you're doing, and that's conventional. Um, so,
But
and
that's
then
an
if you're going
investment.
no ratio, completely no ratio loan with a certain investor, it might be high eights, right? Maybe low nines, but still beats out hard money every day. I still think it's a great product if you know what you're doing with it. You can even do interest only terms where you're the first 10 years you're on interest only, and then the next 20 you amortize, so you can always refinance in that certain time. So if you're looking to maximize your income coming from the property, you can easily turn on the interest only feature, and you can actually qualify off of the interest only payment as well. So if the principal and interest payment is the standard of the property charges, say it's at $2,000, and you do the interest only, and that drops down to $1,500 a month, and your rental income's at $1,500, that's a 1-to-1 ratio. So that would be okay in that scenario.
What did I miss? I'm thinking I might have missed something in the beginning. Can you use your cash flow from other rentals to justify the DSCR loan payment? I mean, like say I have like 5 houses and they cash flow like more. I mean, the what I'm trying to say is like you can cover the loan payment for the new investment property, even if it's not like up to like say you're going to remodel it a little bit to make it worth more rental wise. Can you use your income from your other properties to justify the DSCR loan on one property?
No.
So it's
No.
just projected income from the one property you're buying.
Yeah. So this program is just going to look strictly at pretty much your score, your assets, and the property.
Okay.
That's it.
Okay.
They're going to want to be disclosed how many other rentals you have, right?
And how much equity.
But they're not going to look at your tax returns. They're not going to see how much you're getting from those. Now, there is other programs out there called cross collateralization loans, and you can do a DSCR. I mean, you're basically bundling, right? And maybe you have a lot of value in one property and you're doing an acquisition on another property, and you want to cross collateralize that into one loan, one big loan or whatever. You can do something like that.
Yeah.
But as far as like, hey, I have good cash flow over here, not here, but these two I want to show, it's they're going to look at just the property itself. And on a refinance, they're only going to want the housing history on your primary residence, right? And they're going to just want the housing history on the subject property for a refinance. So if you want to do a cash out or something like that, you can certainly do that, or a rate and term if you want to get out of hard money. And the other option, if you're doing like a purchase, you can just, obviously you're just going to verify your housing history on your primary. And then typically they're going to want, like if you're doing a big purchase over $1.5 million, you're going to see conditions on there for at least 2 full appraisals on something like that.
Mm-hmm.
They're going to scrutinize the property quite a bit because that's their only really meat and potatoes on it. They don't have anything really that they're documenting from you that you can pay it. So They're, if it's under 1.5 million loan amount, then they're going to ask for like what's called a CDA, which is a collateral desktop analysis. That's going to
Right.
get your appraisal, and then they're going to make sure that they don't have any variances on that appraisal report for the value.
So it's definitely a great loan option, but it's not.
It's fantastic for investors.
It's not super accessible to everybody. But for someone who's used to
no, like you wouldn't want to do it as like a first time home buyer. I would be wary on it.
Your first rental property.
Yeah, I mean, there's probably a place for it if you. Let's just say this would be an example of someone I would consider be a good, maybe first-time investor for it, is if your parents passed away or something like that, and you got left an estate. Maybe you got left a house, and maybe you got left $350,000, right? And you want to put a renter into your mom and dad's home, right? And you put a renter in there. Maybe you want to pull out $200,000, and you're going to get that $200,000. That's going to cash flow itself. Okay. And then you get that 200,000, then you combine that with maybe 300,000 or that 350 that you got left. Now you've got 500, you got $500,000, and you want to go purchase a $700,000, $800,000 investment home, right? Park that money in there, put a renter in there. That would probably be a good use for a first time investor, especially if their income wasn't quite where they want it to be yet.
Yeah.
Maybe they're still young in their career and they want to park the money. That might be a good fit.
Awesome. Definitely great things to consider.
Yeah.
Is there anything else lately, that any cool tidbits or information or what's going on here for, local incentives or any sort of programs like that you can foresee this summer coming back down the pike in terms of like from the state or from local government?
For primary residences, so CalHFA still has their ongoing down payment assistance program out there, which is they're going to provide the down payment. They're going to loan you the down payment for either your first home for either a conventional mortgage of 3% down or an FHA mortgage for 3.5% down. They have that ongoing all the time.
Yeah.
Funds don't run out. CalHFA, the Dreams for All program, that portal is shut off. Now they're going to be drawing the winning lottery tickets, I guess you'd say. And so that'll be coming out probably in the next month.
Yeah.
They'll have the results for that. GSFA out there still has down payment assistance programs out there available. And you don't have to be a first time home buyer to get a GSA loan.
Right.
So you can be buying your second home and maybe you just need a little bit of help with the down payment. GSFA would be the way to go. They also have very specific industry type of down payment assistance available out there for the type of work that you're in. So if you're in medical, you're in police, you're in you work for the county, things like that. They have certain programs out there available to help out with your down payment if you're going to buy that next home. Again, no first time home buyer requirement is required on that.
Cool.
So those are some good ones out there. And then, I think another good loan source is obviously, if you can qualify for a USDA loan, which you don't see much people qualifying for that one.
It's kind of like one of those it's kind of like one of those aisles in the grocery store that you never go down, but you're like, there's some food down there.
But it exists. There's something down that aisle, but I never go down there. Yeah.
Yeah, but it's available. You never know when you pull it out of your back pocket and
the other one I would explore a little bit more. I mean, that might be a good for some folks is let's just say you have a home that maybe you have an investment property and you want to spruce it up a little bit. You have every right to do a renovation loan on that home, right?
Mm-hmm.
So you could do maybe you have a one unit you want to buy and it's an investment property. You can do a renovation loan on an investment property. It's totally fine to do that. You can do it on a second home. Obviously, you can do it on your primary residence. So I think that's probably a really underutilized tool that we do have out there is the renovation loans. I think also the energy efficiency mortgages as well as another highly underutilized loan product I'm going to do some more training on myself because I think there's a niche out there for that, especially for homes that are placed in fire areas
Uh-huh.
that you want to take down. Maybe it's advisable you take down the brush to make the home safer. Maybe it's advisable you take down some trees around the house or something like that that you can wrap into the mortgage.
Yeah.
You know, make the home more comfortable and put smart meters in there, smart thermostats,
Uh-huh.
new water heater, things like that to keep it, you know, the home safe and comfortable. And, you know, maybe there's flood zones in certain areas and you want to make a little barricade to, you know, keep the water flow off of the property or something like that, you know, certain diversions. So there's some great financing tools that's out there. I think it's probably underutilized.
They have like financing tools to like keep the fire hazards down so we can get home insurance in North County.
Yeah, I know. That's what I'm trying to, like, you know, myself strategize about that and see.
We're in the market to buy a house, and I don't know when. I mean, we're kind of like getting settled into this rental that we own and just kind of remodeling it while we live there. And we're looking at houses and then kind of like running numbers like possible insurance number. I mean, fire insurance is no joke, but that's another a topic for another episode. Home insurance, and I don't know if it's just North County,
guy on here or insurance gal.
Yeah,
walk us through that because that's been a toughie. I mean, right now I've got 2 investment properties right now. One's utilizing the DSCR with their purchase, and they're going to have to go with the California Fair Plan, right, on that one. So that's going to be expensive. Mm-hmm. Thank goodness we're doing the no ratio loan, so that way it doesn't really affect that. And the other one, they're doing it with a conventional investment loan. So everyone's a little bit different, you know, in how they want to qualify. This happens to be their first investment property, and so made sense to kind of go with the conventional route. But you know, and then you have the accredited investor. They're doing the DSCR deal, you know, so it's less headache for them.
Yeah, we went the conventional route with our first investment property because we moved from a condo to our house, and the condo just became a rental. And then when we were living in the house, we bought the duplex. So it's kind of it was our first purchase of an investment property. But
you purchased an investment property?
Yeah, like 2021, like spring of 21.
Oh, that's a good time to buy.
But the commercial, the conventional investment loan percentage, like the rate, I think it was only just barely above, maybe around like what a regular mortgage loan goes for now. So yeah, at the time it was like 3 or 4% more than what people are getting houses for, rate wise. But now it's like kind of equal. So it's just interesting how that it all fluctuates.
Well, and then all the different administrations that are in, right? Mm-hmm. They're going to dictate what kind of. Back then, you may not have had certain loan level price adjustments yet. Mm-hmm. That wasn't pushed down from the administration, right? Say, you know, maybe there's a new FHFA director, and that happened in 22, for instance, or something. You know, it's like you get new people in there, and they go, you know what, we want to make, we want to incentivize first-time home buyers, right? We don't want to incentivize investors. So what we're going to do is we're going to charge investors extra points to get this loan. We'll still honor the loan. We'll still have Fannie and Freddie Mac purchase the loans, right? We're still going to back them up and keep the money liquid out there. But we're going to implement loan level price adjustments to investors for these type of loans, and then we're not going to do that to home buyers. Right. Mm-hmm. So that's how they kind of try to even the playing field a little bit. So depending on the type of administration that you have in office.
Right on. Well, hey, man, a lot of great stuff, a lot of great topics. I think the main lion's share of this video is going to be the information on the DSCR loan. And I really appreciate your insight. And I hope somebody out there gets something from this video. I'm trying to make this title searchable so you can get more DSCR information. And feel free to reach out to Harry or myself for more information. We'll put the information in the description. And Harry from Equity Reach Mortgage in San Luis Obispo County.
Yes.
Serving more than just San Luis Obispo County. but he's your local expert, and always great to have you on the Peak Show.
Oh, thanks, Seth, for having me on,
Yeah.
and I'm sure hopefully you'll get some investors giving you some calls, and you can show them some good investment opportunities out there that you have in your pocket.
All right, man. Thanks a lot, Harry.
See you, man. Take care.